Good morning, everybody. Thank you for joining David Arbett and I today for your monthly housing market update. Just before we get started, the few reminders. This webinar is being recorded. It will be available on our website later today. Also, we encourage any questions throughout the presentation. So you can either raise your digital hand or use the Q&A or chat functions at the bottom of your screen. And with that, I will hand it over to David.
It is an honor to be here with you all, stats fans near and far. You know, I got to say, I was thinking, it's always a real honor and a pleasure to be around people who care about your work and who are interested in what you do, because I'll tell you, my wife is getting pretty sick of hearing about it. Anyway, let's get going today. Before we kick off, as we do, we insist on thanking our sponsors. Without them, what we do wouldn't be possible. So we want to give a shout out to Bell Bank Mortgage, North Star MLS, RCU Royal Credit Union, and Supra over at Supra Key. So we also have been mentioning that we have a rebuilding community page. I think a lot of stuff there is still relevant, so do check it out. And then, of course, we also still have our COVID page, which has tons of great info from market stuff, policy world, everything in between. So do check that out. Okay, a little bit of an outline for today. I'll admit right off the bat, item number 3 is going to be a little bit of a pipe dream here, just because we have so much to talk about. If we have time, in the final 5 minutes or 10 minutes, and if there aren't a ton of questions, I'd like to hop into InfoSparks, time permitting, but please don't hold me to that. So we'll talk the market, showings, buyer-seller activity, activity by price point, and then importantly, we want to put that July activity in context. Given what's been happening and some of the claims and assertions around town and on social media, we felt it was important to address some of the Minneapolis-specific dynamics and market activity. So we'll spend a decent chunk of time on that. And I just want you guys to brace yourselves because data analysis is coming. All right, first a few quick headlines. Housing market rebounds as states reopen. Existing home sales up 21% in June, largest ever. U.S. housing set to ride out the pandemic. 5 reasons why the market has recovered from COVID. There's a bold claim. Fox Business is saying U.S. sales of existing homes jumped 20%. America's housing market so far unfazed. It's official, folks. The U.S. won't see a housing bubble crash anytime soon. Well, if you say so. How about luxury? U.S. luxury housing market saw prices and demand growth in May, so that's a couple months ago, but we'll take a look at some of that. How about Forbes? Mortgage rates, record lows. Is now the right time. Yahoo, mortgage applications, home purchases up 1/3 as rates hit another record low. Wash Post, mortgage rates just hit a new low again. Here's Forbes again. Mortgage interest rates fall to their lowest rate ever recorded again. All right, so that's kind of setting up a little bit on rates. Let's kind of jump into the market. We have 3 overarching trends still. And those are that buyer activity remains strong, listings under contract, what we call a pending sale, that's our pending sales metric. Those reached their highest July level since at least 2003, but likely longer. So, our data only goes back to 2003 because that's just when our North Star data, starts to be valid. But it's very likely that last month, this July, was a 20-year high for contracts, although we can only prove that it was a 17-year high. We also note that a lot of activity from May and June was postponed or delayed or displaced into July. So yes, the July numbers, strong and a multi-year record, even almost a multi-decade record. But I think we have to keep in mind that some activity from spring market was delayed into, July, into summer market. So we'll keep talking about that a little bit. Seller activity remains weak. So sellers are, even though we saw a little bit of a bump in July, overall this year, sellers are still listing fewer properties than they did last year. Some cities saw a larger gain, some cities still saw losses in seller activity. Inventory, as you all know, is by far the biggest factor holding back the market and frustrating and challenging buyers. So active listings still down about 66% from 2010, even though we've had population growth since. All right, how are we doing on the 30-year? See if we can get our laser going here. 30-year, actually under 3%, 2.96, pretty remarkable. I'll just take us back to 06 here, the last time prices were this high, but look at what we were financing those purchases at, about 6.75%. Well, we're less than half that now. So even though prices have risen, payments haven't necessarily kept pace because of rates. Those remarkably attractive rates have, of course, kicked off a major refinance wave. We can see that wave of refinance earlier this year. It continues to be at elevated levels, although you guys can kind of see, when this spikes, it does tend to come down fairly quickly, just like we saw here. So our lender friends are busy. So that was refi. How about the Mortgage Bankers Association, just their purchase applications? So this is new purchase applications, from first-time buyers or move-up buyers, not necessarily, not at all refi applications. So this is a great leading indicator, guys. It stands to reason if you're applying for a mortgage, it stands to reason you would like to buy a house. I know that's a radical conclusion there, but seems to be logical to me. So you guys can see, based on mortgage purchase applications, there does appear to be a V-shaped recovery here. That does not apply for the whole economy, although it does seem to apply to stock market, interestingly. This does not apply to the entire economy, nor to the entire market. But for this indicator, purchase applications, this has gotten back on trend, as we say. So just a couple ways to think about this, you guys. Why do we care about that? Why would we look that far back in the process? Well, think about a life cycle of a listing. Sellers, it's new, then it's active, then it's pending, then it's closed. How about buyers? Buyers, they start, as we all do when we do something new or want to learn about something or research something, we start with a Google search. There's also a hit on the listing traffic that sometimes we can monitor. And then you go to mortgage pre-approval, then you go to showings, then you write an offer, then you close. So there's sort of this life cycle here, you guys. And the earlier into that life cycle we can get, the better we can predict activity down the line. So if you want to look at closings, look at offers. If you want to look at closings tomorrow, look at offers today, and then look at showings yesterday. So there's sort of this flow or this life cycle that I think is important to note. I know we mentioned one of the first things you do is Google it, right? You Google it. So Google has this thing called Google Trends. And I typed in the search term buy a house. So this is tracking how popular that search term is over time. We go all the way back to 2005. And I think, notice here, this goes through about 2 days ago, pretty recent, keeping it pretty fresh for you all. You guys can see that this search term actually reached its highest popularity since 2005, at least in Minnesota, right? California, Alaska, Texas, and Florida, your results may vary. Your mileage may vary. But I find this pretty compelling and pretty interesting. How about we throw in get a mortgage? All right, that too is at pretty elevated levels. Maybe we had some refis here where you kind of see a little bit of a higher level, but you can definitely see elevated interest in buying a home and getting a mortgage. How about Realtor? Hey, look at that. Highest since 2005. The search term Realtor is at just about the highest popularity it's been at since 2005, based on search terms just in Minnesota. Pretty interesting. Okay. Let's transition now. That was kind of early in the process with mortgage applications and Google search terms. Now we want to look at some daily, weekly, and short-term trends. That's going to be part A. And then we'll transition into part B, which is going to be more focused on monthly and what we think of as longer term trends. All right. So this is a common one. This is a popular one. You guys have been seeing this since, I think, late April, maybe mid-April. This is where we track daily showing activity, but we use our rolling weekly average. So the couple big takeaways here. First of all, showing activity in 2020 in blue, started off the year pretty strong, outpacing last year, even though last year had some weather challenges. This year was still looking quite strong. Then COVID hit, and then we kind of saw the impact there. What's been so interesting, since we got back on track this year with last year's showing activity, what's been so interesting is that we've trended well above last year's levels. So we started above, COVID kind of shoved us below, and now we've been hovering above. So the question is, and this is an interesting one, the question is, can this area under the curve make up for this area under the curve, right? Maybe I should say this area under the curve and this area above the curve. If those can kind of balance out, the year could be a wash, or we could even see a gain. And by the way, you guys, pendings are up for the year. It's kind of an amazing stat. We'll get back to that a little bit later. But year-to-date contract activity, I think, is up 1% or 1.5% for the year, which is pretty remarkable when you think about some of the challenges that we see right here, of course. So hovering well above, that's promising, you guys. Why? Why do we care about showing activity? Yesterday's showings are tomorrow's signed contracts, which are then Saturdays or maybe Mondays closings. Of course, it doesn't happen that quickly, but you guys can kind of see how things flow in the process chronologically. So overall showing activity by price range, we're going to fly through some of these guys because I guess we've got some other more interesting stuff to get to today. So big takeaway here, you see losses in under 200,000 as we've been seeing for weeks, months, if not years. So about 8,000 down to about 6,500 showings at that most affordable price point. You can see gains in our next leg up, 200 up to $250,000, $250,000 up to 300,000. That's where we see our largest jump. No surprise there. And then we do see gains all the way up the price ladder into luxury. So just a word, you guys, on the product mix effect, the PME, product mix effect. So not every house is worth 10% more every year, even though prices might be rising 10% from last year. That doesn't mean your home is worth 10% more. It could mean that higher priced homes are showing or selling, and that drives up market-wide prices. So look at what we mean by this, guys. We saw less activity in affordable, more activity in some of our mid-market ranges and luxury. Well, when those go under contract after these showings and when they go to sell, that's going to drive price points higher. But that has more to do with the mix of homes selling than, a supply and demand type dynamic. So sure, supply and demand are still very much at play here, but I think that we discount this a little bit too much, this product mix effect. When you have more $1 million plus homes selling and fewer homes under 200, under 200,000 or so, obviously that skews prices up toward this range. So just a note on that, just so we kind of keep that in mind. All right, so that was the number. How about the share? Nothing that new here. 30% down to 20%. Pretty big decline in the market share of showings under 200,000. Looks like our biggest bump came by way of maybe that affordable mid-market range, or that I know it's a popular first-time buyer range, 275, 280 if you can find it. I know 3.25 is also pretty popular for first-timers. But you guys can see how the share of showing activity has risen from the same week last year. So most recent week this year versus that same week last year. So million plus showings were only about 1.3% of overall showings last year, but they're 1.65% of overall showings this year. Change in showing activity. There's the only one we show a loss in, folks. Down 19% for showings under 200,000. Everything else was up to varying degrees. Hard to put up double-digit gains. So we were about 8.5% in this, our second most affordable segment. And then we see a nice 60% gain in showings between 600 and 800,000. So that could be move up buyers, folks looking to take advantage of these low rates, or families who feel cooped up in smaller homes who are looking for homes with 2, maybe 3, maybe 4 home offices. I say that somewhat tongue in cheek. So let's look at new listings, guys. This is for the Metro. Again, our rolling weekly average. 2020 in black. Prior 3 years, 2017, 18, and 19 in varying shades of blue. You guys can see the COVID impact, right? We were looking pretty strong in terms of new listings. Sellers were looking pretty confident, feeling pretty good. Then COVID hit. You guys can see the impact there. Looks like we got back to those levels, but we've really kind of flatlined since then. You guys can see that in past years, in prior years, you know, we actually kind of belong up here in a normal year. Well, at least based on the prior 3 years. What's I think positive is that we've sort of reconverged, if you will. So 2020 was hovering well below. You guys can see the gap here, and then it looks like that gap has closed, and we've reconverged with prior years. I think that's okay. I think what buyers would have liked to have seen is, because there's so much demand out there, we really need to fuel that demand or supply that demand. And it really requires the cooperation of sellers. Builders can help. Builders can definitely help, and they are helping. But it's just new subdivisions in the suburbs just aren't enough. So we need more churn, more turnover in the market. Okay, pending sales again, metro-wide. You guys can see the impact of COVID here. So look at this one. This one on the demand side, pendings easily got back to highs for the last 4 years. Sellers, no such luck. Sellers did not exceed those levels. Buyers easily blew past those levels, and they remain at elevated activity levels, right? They remain above the prior 3 years. Here you can see the 4th of July break. Notice in past years, we had a real slowdown. Buyers barely took a breather. That you can definitely see some folks were up at the cabin, but it really wasn't as big of a dip as we've seen. Perhaps we're seeing some early signs of reconvergence after being well above. If we don't have the cooperation of sellers, it's hard to see buyers continue to outpace activity levels from the past 2, 3, 4 years. Let's take a look at year-over-year monthly change, transitioning a little bit here. So we're looking at seller activity, change in new listings, July of this year versus July of last year. You guys can see pretty much all of our affordable segments under 250 had fewer sellers. If I owned a home in those price ranges, I probably wouldn't be getting rid of it either, because I'd understand that it's going to be really hard to replace that product, in that location, that close to where I want to be, even though there's been some changes in the centrality of location in our decision making. We see a 25% gain in seller activity between 3/4 of a mil up to a mil. And then we see, we do see some nice gains. I think this is important, this 250 to 350 range, that we saw 11% more new listings than last July. This is pretty encouraging because this is a popular price point. Obviously, our median is, I think, about 310, 312. So it's obviously, within this range. So it's nice to see a gain here. It's pretty important. Don't discount this either, guys. Just like I said, about a 2% gain in new listings compared to last July. How about on the demand side? 11.3% increase compared to last July. So seller activity up 2%, buyer activity up 11%, just like we were saying moments ago. To continue to sustain this market, we're going to need the participation and the engagement of sellers and builders, and we're going to need move up buyers. We're going to need some changes if we want to continue to fuel this market. You can really see the demand growth in some of our luxury segments here. Pretty interesting. Some of these segments pulled back pretty heavily, so it makes sense that they're up a lot. Also, a lot of these segments follow equity markets, so stock market. The S&P just got back to its all-time high. I think the NASDAQ was already back at its all-time high in that tech-heavy NASDAQ.
Hey, David.
Yes, ma'am.
We just had a question come in, wondering why you think sellers aren't wanting to list.
Yeah, I got a whole laundry list of answers there. Um, I just think it's a game of musical chairs. I think people are scared to get rid of what they got because they don't have confidence that there's going to be a chair for them to sit down in once the music stops. So I think people know that prices have been rising fairly quickly, faster than incomes, um, in some ways faster than inflation, depending on how we measure that. So I think people are staying put. NAR has some research on that shows the median tenure, or how long homeowners spend in their homes, has jumped from 5 years to 10 years. I think since about 08 or 2010, we used to move every 5 to 7 years. Now we're sticking around for 10 years. I just heard on the news, Home Depot sales, record sales, stock is way up. People are remodeling. People are staying put and remodeling. Not all of them. There's obviously still some seller and buyer activity, plenty of it. But the dynamic has changed a little bit. When you see such an inventory shortage, it tends to be a self-fulfilling prophecy. I'm nervous to list my home because there's nothing else out there. Well, that then becomes a self-fulfilling prophecy. Others don't want to list because there's nothing out there. And then there's nothing out there. So we'll keep going on some of those reasons. We'll keep talking about that. Looks like it was Janie who asked that, and I've got a good slide, so I'd love to follow up with Janie. I've got a list from actually a year or two ago we produced that, so I will follow up with Janie. Good question. So I've just kind of plotted these both with each other, guys. So this is July of this year versus last year. This is new listings in gray, pending sales change in blue. Just an observation. Demand growth is outpacing supply growth in all price ranges at or above 250,000. Like this one, blue is above gray. Sales growth is above new listings growth. Same story here, here and here as well. I think that's pretty important, that demand growth is outpacing new supply growth. All right, new listings. We're now pivoting into some of our longer term trends. Since there's been so many changes in the market lately, particularly over the last 3, 4, 5, I'd even say maybe as long as 6 months, because the year started off so strong. And I guess that was different than the first quarter of the prior year, even though it was pre-COVID for most of the first quarter. So just want to put this in context, you guys. I think it's important to kind of contextualize what we're seeing with our long-term past and sort of anchor that against the past, or compare it to the past. So you guys can see 03, right? Look at our climb in new listings, and then enter the Great Recession. And you guys can see we had almost a 50% decline, maybe a 40% decline in new listings. We worked our way up a little bit into 14, 15, but you guys can see we've flatlined since. We're actually down a little bit. Now we're up a little bit. It is pretty impressive that we're able to put up that 2% gain. Although remember, a lot of sellers who would have listed in May or June either didn't want to, were prevented from doing so, were concerned about health impacts, and other reasons. So I think a lot of that activity was delayed or postponed into July once again, like we discussed. How about on the pending sales side? Shifting over to our demand side. This is where the proof is in the pudding, you guys. Look at, we had 6,900 signed contracts this July. That was about 11% more than last July. And based on my eyesight, yes, highest level since at least 2003, easily eclipsing this July of 2004 figure. So this chart is what enables us to say, based on the North Star data for the Twin Cities metropolitan area, July was a new record going all the way back to 2003 for signed contracts, likely since at least 2000, maybe longer. I wish I had that history. We just don't. So what we can say is it's at least a 17-year high watermark for accepted purchase agreements. How about closed sales? Are all these pendings reaching the closing table? It looks like they're finally starting to. right? So we saw a 4% gain in closings. I can't recall, forgive me guys, I can't recall if last month we saw a gain, but I know that, well, like we talked about at the beginning with the life cycle of a listing, once we see increases in pendings, it's usually a month or two, sometimes three, usually two, until we see those gains move into the closing phase. So gains in Google searches translate into gains in mortgage purchase applications, translate into gains in showings, translate into gains in pendings, and then finally meander over to the closing table. So let's take a look at this, guys. This is from a Calculated Risk blog, a blog I follow pretty closely that really just does a tremendous job on a whole lot of different sectors and industries in the economy. So this is new home sales, seasonally adjusted annualized rate. Forget all that nonsense. Honestly, just look at 2019 in blue, 2020 in red. You guys can see this year was trending above last year until March, and then it wasn't, and April, and it wasn't. But May, it was, and June again, it was. I didn't see July data for this yet, so forgive me, this is a month or two old. But look at this, guys. Blue is that much above red there and there. Red is that much above blue there and there. So let's compare these two. It looks like we have, at least on a national basis, it looks like we haven't quite made up these losses. These gains haven't yet overcome these losses. We can see that when we stack them up. Kind of an interesting way to think about it. That's new home sales. Even though they've been outpacing year-ago levels, they haven't made up for the declines from earlier. How about existing? We are still not above 2019 levels on the existing side. Pending sales year to date, just like I said, you guys, I think I said 1.5% or 2%, I think I said 1.5%. Thank God I was right. Every now and then I get something right. So this is year to date, guys. You know, considering a pandemic and everything that happened in the second quarter of this year, it's pretty remarkable that we have a 1.5% gain year to date in signed contracts. That really is quite a remarkable figure and a remarkable feat. You'll also notice, though, you know, we are not above 2016 and 2017 levels. All right, CDOM, cumulative days on market. Everybody's favorite, right? Well, one of our favorites anyway. So this is looking at market times. Homes used to take 100 days to go under contract. That's a long time. That was 12 years ago. Lately, 17 days for last month, right? So July of this year, homes took a median of 17 days to sell. Half the homes took longer, half the homes took less time. So what is that, about 2.5 weeks, 2 weeks and 3 days by my back of the napkin math? Original list price. So forget what buyers are paying. What are sellers listing these at? About 315,000. Up about 5.33% from last year. How about sold price? Oops. Okay, hang on, guys. All right, we're going to do something a little interesting here. So this is June. I almost forgot I did this little trick. This is June. June saw 5.25% jump in median sold price. So June, 5.25. July. Here's July. 10.5. So the rate of price growth doubled in the metro, right? So 5% year over year in June versus 10.5% year over year in July. You know, like we said at the beginning, you guys, that does not mean every single listing, every single homeowner is worth 10% more right now, right? We know it doesn't work that way. However, that cross section of home selling, remember, many of which are newer, many of which are bigger, and many of which are more luxury oriented. We saw growth in that luxury market. Well, several of our luxury segments, I guess. So that can drive this figure higher. It's not necessarily that every listing, every home is worth 10.5% more. That would be kind of a interesting thought experiment. But it's, again, it speaks to this cross section of home selling. Price per square foot, PPSF. Some of you love this, some of you hate this. I'm aware. It's just one more lens through which to assess market health. It's one more lens to look at the market. It's one more metric, that can kind of help us evaluate what's happening. Buyers, I almost caught myself saying on average, on the median, buyers are spending about $157 per foot, so just under $160 per foot. As we pointed out last time, I think this is important, guys. Home A and Home B. One cost $200,000, the other cost $400,000. But the square footage of the $200,000 home is $2,000. The square footage of the $400,000 home, twice as big, 4,000 square feet. Well, guess what, my friends? The price per square foot of those two homes is exactly identical at $100 per foot. So I don't care how many feet you have. You may have 650 feet or you may have 6,500 feet. It does not matter. What we're asking is, how much do you pay per square foot? Per foot. It really lets us sort of level out. Well, look at you guys. It lets us correct for the fact that a home is twice as big, sells for twice as much, but the actual cost per square foot didn't move a penny. It didn't have to. So I think that's pretty interesting. That's why I like PPSF. Not saying it's a magic bullet, but it is another tool in your toolbox. Oops, forgot I did those. Okay. July percent of original list price received at sale. Twin Cities wide. Over 100%, my friends. I think there were a few months last year that did that. I'll double check on that. But this is again a pretty remarkable figure. Remember, this is original list price, not current list price. Once you've had a price adjustment, this is original. Sellers are getting 0.1% above their list price. Pretty amazing. Even in the bubble years, right? 03, 04, 05. We never even hit 99%, at least for July. When after the Great Recession and the mortgage crisis, lots of foreclosures, lots of fire sales, people selling them short and whatnot, banks trying to divest and get these troubled assets off of their books before earnings reporting season comes. Sellers got less than 92%, so they had to scrub 8% off of their original list price, right? They were accepting 91.7% of their original list price. Now, I don't know if I'll say desperate, but it was a buyer's market here where sellers were eager, I guess I'll say, to lure in or attract those buyers. Now, if you're going to try to lowball me on my listing, listen, pal, I've got 2, 3, 4, sometimes 6 full price offers, half of them in cash, waiting in the wings. Obviously each city is different, each price point is different, but just one example. Inventory, yes, 9,600 active listings last month, down 26%. Can you guys even imagine when we had 37,000 active listings? Pretty insane. I guess I'll go on the record and say that. How about, this is from Myers Research based on Realtor.com. Here we are, Minneapolis. Wow, 26%. It's really nice when they agree with us. Of course, they use our wonderful data. So, kind of putting this in context, Minneapolis, I guess we're somewhat middle of the pack. Miami only down, looks like 11%. Chicago down 32%. So, I guess we're toward the larger decline. But, there are some regions that have had lesser declines in actives and some regions that have had more dramatic declines in actives. Hey, there's our wonderful Spoon and Cherry. So July months of supply. So 12 years ago, you guys, we had 11 months of supply. That was a buyer's market, right? Inarguably a buyer's market. Now, less than 2 months of supply, we are undoubtedly in a seller's market, and we have been for some time. So this tells us sellers are going to be yielding a really high share of their list price. In this case, last month, 0.1% over their original list price. It tells us that homes are going to be selling quickly in near record time, as they are. It tells us prices are going to be rising pretty quickly, as they are. So, don't discount this. I know it's a little bit of a nerdy metric. It's that ratio of supply to demand. So 10,000 active listings divided by 5,000 pendings per month equals 2 months of supply, right? The math can be pretty simple. Well, it is pretty simple because 10,000 divided by 5,000 sales equals 2 months of supply. All right, let's get into some Minneapolis specific activity, and let me do a quick time check. Okay, I think we're okay. So Minneapolis specific, and I know this is ironic because I'm showing the Landmark Center, which is in St. Paul, one of my favorite buildings in the whole metro area, if not the whole state. It is just so stunning inside and out, truly a treasure. So headlines, you guys, are they real? If so, do they tell us something? A staggering number of homes just hit the market in Minneapolis. Nearly a quarter of the homes for sale and 43% of the apartments for rent hit the market since the violent rioting began in the city. Well, let's take a look at this. Minneapolis. How many listings were listed X to Y days ago? 0 to 30 days ago. 51% of the listings in Minneapolis. And just a note on this, guys. This is about 2 weeks old now. So, a little bit aged. Data doesn't necessarily get better with age, like a fine wine or cheese. But, it's pretty recent. So forgive me. I'd like to update these. I'll update these for next time. So 51% came on in the last month in Minneapolis versus 54% St. Paul, 66% Bloomington, 56 Brooklyn Park, 53 in Plymouth, and 60% in St. Louis Park. So actually, what our North Star data says is Minneapolis, of these 6 large cities, actually had the smallest share of its listings come online within the last 30 days. So, yeah. I find that interesting when our data kind of directly negates. Well, it doesn't negate it. I mean, it is. It's half the listings came on in the last 30 days, but that's not uncommon, especially in a fast-paced market where things are selling. What did we just show you guys? Things are selling in 17 days. So it's not that big of a surprise that a lot of what's active has come on in the last 30, because anything that's been on, well, assuming it shows well, it's in good areas and remodeled or turnkey or whatever people are looking for, it gets snapped up pretty quickly. So, I found that pretty interesting. Other narratives, supporting evidence for this urban exodus narrative is at best flimsy and at worst non-existent. All these stories about people fleeing cities are total nonsense. I thought that was interesting. The truth may be somewhere in the middle here, but I think it's pretty important to use data to really look at this, and not just accept what we read on social media as fact. So, Fortune magazine did some interesting coverage. Tales of Americans fleeing cities in droves are overstated. 64% of prospective home buyers are looking at suburban areas. A figure that has barely budged from previous years, right? Millennials are having families and looking at the suburbs just like the generations before them. There was a little bit of a delay, but it's not like it was canceled outright. This was good coverage from Brian Johnson, our friends at Finance and Commerce. To paraphrase Mark Twain, the death of the Minneapolis housing market has been greatly exaggerated. I'll also quote Mark Twain and say, if you believe everything you read, you had better not read. Pretty cool. Also, they actually just grabbed our chart exactly, which I thought is pretty cool. Okie dokie. So Minneapolis new listings. Let's just dig into this, you guys. So this is May of last year, right? This is May of 2019. You guys can see where that figure's at. And this is July of 2020. They're just about equal. That tells me that this decline in the beginning of the year, well, first half of the year, which we do not see in the first half of pretty much any year, right? We don't see a dip this side of the curve, but we did here because of COVID, of course. Well, a lot of that activity, like we said, that would have taken place in May and June of this year instead took place in July. You might even say, April and May and June. I think some of those April guys probably got on got online in May or June. But obviously, these are the facts, right? This July really wasn't all that different than last May. And we know that spring market of this year was delayed into summer. So therefore, it's no surprise that summer market of this year looks and acts like spring market of last year, just like we're showing here. Also, I think I've got one more little note here. So that was May. This is July of last year. So if you actually look, you guys, July was pretty low. So what do I say? I thought I had a note here. Maybe not. So the baseline activity matters, you guys. What happened in the baseline period matters. So just like we said, this year's spring market has kind of become the summer market. Sorry, you guys, that's where I mentioned the baseline activity matters. These changes can appear extreme because we're comparing this to this. If we actually look at spring market last year versus the spring activity that's instead taking place in summer of this year, again, we're really not seeing any kind of surge compared to peak of the market last year and even prior years. Let's compare that to the Twin Cities. So this is May of last year versus July of this year, still well below, right? Still well below. For July of last year versus July of this year for the Metro, there's our 1.92% bump. So, the city had, a decline last year in July. I'd have to dig in and see what was driving that, if anything, but sometimes it's just a quieter month for sellers. You guys can kind of see how that baseline activity impacts the current change for both the city and the Metro. Alrighty, July new listing. So I do want to go over some changes that we are seeing, particularly by way of condo. I guess in this chart, it looks like we're seeing the most dramatic changes in townhomes, but we'll keep looking at that. So July new listings compared to the prior year, single family in Minneapolis up 34%, condos 44%, townhomes doubled by a little over 100%, but we're talking from 15 to 30, right? 14 to 29. So it's not a ton of new listings by count, but it is a large percent change. So how about Edina? Oh, Edina saw a 100% increase in condo new listings and a similar 27% increase in single family new listings. So I don't think people are fleeing Edina. Sorry, sometimes I crack myself up. I don't think people are fleeing Edina, and we saw an even greater increase in condo listings in Edina than we did in Minneapolis. So I don't know. So some of these narratives seem a little bit off to us.
David.
So yes. What do we have now?
Wondering. Well, I'll just read it. So I realize you don't have stats specific to rentals, but wondering if you could speak to anything, especially in the downtown Minneapolis, regarding rentals.
Yeah, thank you, Missy. I'll do my best to address that. We really don't have rental data, but what we're hearing is that rental vacancy rates, while they're still low, I know we're still building multifamily, but similar to higher density condo developments, I know there are some health concerns with some of those higher density rental buildings as well. In fact, the same ones. So maybe that's an indication that single family rentals will be popular in the coming years if people are looking at maybe having a little bit of their own space without sharing doorknobs and elevator buttons and mail rooms and whatnot. So I think there's a lot of dynamics going on. I guess we'll keep looking at the data, but I guess I see the dynamic as similar. But I think we have to remember there's also some socioeconomic differences. A lot of the condo owners, particularly luxury condo owners, have a little bit more financial wherewithal. So it's easier for them to, make a decision, move or keep a second home, keep a condo in the city if they want. I know people do that. Or Florida snowbirds who still have a condo in the city, or Arizona, I should say. So there's a whole lot of dynamics going on. I think some of these charts will address that, but I may need to chat with Missy offline on some of that rental stuff. Even though we don't have data, I do see some of those reports. So we may chat offline. So this is June. We didn't see a big spike in Minneapolis listings in June, kind of similar to St. Paul. Bloomington actually had a big decline, a little bit of a bump in St. Louis Park and Golden Valley, and then an identical decline in Minnetonka. So days on market still down in Minneapolis for June, up in Eden Prairie and Tonka and Golden Valley. And I think that has to do a lot with price point. Typically higher priced areas take a little bit longer to sell. And as you see those markets shifting more toward luxury, or at least more toward mid-market or upper middle market, I should say, you'll see those changes. I'm just going to kind of blow through some of these so we can get to July. Median percent of original list price. Minneapolis sellers, same 100% of their list price they did last June, right? St. Paul sellers went from 101.2, I think, down to 100. I put that in quotes, all the way down to 100% of your list price. Kind of an interesting thing to say. You guys can see what happened as you move through the areas. Golden Valley and Tonka down a little bit. I think, again, that may have to do with price point. I think St. Paul was just so hot. They had some affordable listings. Maybe there's fewer of them. And so, it's easy to go 110%, guys, on a $200,000 listing. It's harder to go 110% of list price on a $500,000 or $600,000 or $700,000 listing, obviously. Typically, those segments also aren't as competitive. Okay, as promised, July numbers. So here's the one that if you were to take this and run with it, you could use it to sort of twist and support a narrative that may or may not be there, right? So this 41% increase in new listings in Minneapolis does appear to be quite strong. We already saw that it's really not that higher than last May, but it is 41% higher than last July. We already looked at the historical chart, the one that kind of had all the seasonal changes, the one that looked like that. So, there's some good reasons for that. St. Louis Park up 16%, St. Paul, the other core city, up 18%. And then there's our metro up only 2%. I shouldn't say only. It's nice to see a bump in new listings, guys. This is what buyers want. Let me also say, there's an argument that this is exactly what buyers want, right? For every Minneapolis listing, maybe I should say under 3 or 350, it's very common to have 4 offers, 3, 4, sometimes 5 or 6 offers. So perhaps instead of 5 offers, maybe there will be 3 or 4, even if this narrative were to be true. All right, let's keep going. How about pending sales? So, Minneapolis also saw one of the greatest increases in signed contracts, a 21% bump in signed contracts. So sure, there was some pent-up demand to list. There's also some pent-up demand to purchase, and that is starting to be unleashed or released into the marketplace. St. Louis Park, another robust gain here, 40%. That was our leader. BP, Brooklyn Park, our friends up north there, not that far up north, 30% gain. There's our St. Paul, 13%. And Minneapolis had a gain that was double that of the metro. So I don't know if people were fleeing, and everyone's listing their home and no one's buying them, it would stand to reason that this wouldn't be double the metro. Let's also take a look at days on market times. Let me say again, guys, if these claims were true, and I want to say they may apply to a small segment of people, but to say it's the majority, to say there's a flight, to say everyone's fleeing, it just overstates the case and just isn't rooted in reality. And that's why we like using data to educate people, members, media, public. So market times down 21%, right? Home selling in 15 days. That was among one of the quicker times. Again, it stands to reason if everyone's listing their homes and no one's buying them in Minneapolis, you probably wouldn't see them selling 21% faster. You also probably wouldn't see prices rising 11%, right? Because there's so much demand and so little supply. We saw that 11% gain. That was 0.3 higher than the metro, right? Higher than the Twin Cities. I don't think it was the strongest, though. Who won here? Looks like our friends over in St. Louis Park had the highest increase in sales price, 12.33%. Not to worry, my friends, everyone's income's rising at 12.3% every year, right? False. Percentage of original list price received at sale. So here again, if everybody was listing their homes in Minneapolis and nobody wanted to buy them, I find it pretty hard to believe that sellers would be getting 100.8% of their original list price, nearly a 1% gain, right? Versus the Metro at 100.1% and a 0.5% gain. This was not the leader. What is it? Looks like St. Louis Park again. Definitely one of the hottest markets of this group. And I guess I'll say one of the hotter markets in the Metro. It has been for some time. Yes, Missy, we will absolutely send out the slides. So, specifically in Minneapolis, there's our 41% increase. Notice this 931, let's go back, highest since 08. July pending sales, Minneapolis, there's our 21%, 630, back. Oh, shoot, just by one. Highest level since 05. So let me say that again. Minneapolis new listings are at their highest level since 2008, but Minneapolis pending sales are at their highest level since 2005. Some of you may be surprised by this. I think it's worth mentioning this, particularly in light of some of the claims that we're seeing, right? Which makes sense, you guys. Buyers have been more active than sellers, so they didn't have a ton of ground to make up for. Sellers, however, pulled back, pretty dramatically after COVID, and they never really returned to levels from prior years. Finally, we're seeing, a 2% bump in new listings metro-wide, obviously larger for the city. Minneapolis sellers in particular faced challenges getting their properties online. So perhaps it was the unrest that prevented sellers from listing in June and not encourage sellers to list in July. In other words, June activity really was moved into July. Another way to look at this, guys, 100.8%. This is Minneapolis only. This is a record high for July. So really demonstrates the strength of the market. Let's just take a peek at condos. I think I've just got one more before we open it up. Let's take a peek at condos, guys. This is Twin Cities region, so this is metro-wide. However, we know that Minneapolis, particularly downtown, plays host to not a majority, but a large share of our region's condos, especially on the luxury side. But overall, obviously, no one's looking at building a 40-story, condo tower in Roseville or in Savage. So obviously, Minneapolis plays host to a lot more of those. So look at condo market changes. This is percent of original. We're looking at that ratio of sold to list price. As this metric deteriorates, right, it means, well, it can either signify supply demand shifts. It can also mean, there's a little bit less competition. There's fewer multiple offers. Please notice, beginning in August of last year, so a year-long trend, condo sellers have been getting a little bit less of their original list price, right? Little bit less. This trend has been going on for a year, right? COVID just hit us in March. So when some people attribute this to, oh my God, this is COVID related, or this is unrest related, or oh my God, this is, related to something else. Well, I'd show them this. I'd say we've seen changes in the condo market since August of last year. I think that's important. All right, a few takeaways. Oops, pardon number 6, guys. I had another thought. Please forgive my DF there. So July was the month where a lot of this pent-up market activity was unleashed or released, as we discussed. We're seeing, or at least we have seen, this re-acceleration in price growth. We're seeing market times dropping. We're seeing sellers getting over list price. It's really not anything that different over the last 5 years. It just seems to be at a little bit of a higher level with a little bit more urgency, partly because of rates, partly because of, a multitude of other factors. The inventory shortage obviously is still a major concern, major challenge, especially for first-time buyers looking to be under 200, 250, or 300,000 really. Rates are a huge draw, huge incentive, big motivator, especially for first-time buyers, especially for The millions of Minnesotans who are making less than our state or region's median household or median family income. And then 5, core cities, I think, are experiencing a short-term disruption. Um, Anecdotally, it appears to be largely related to health concerns and the closure of activities, or the lifestyle, and a desire, as well as a desire for more space for telework. Sure, the unrest may have played a role for some, but to claim it was the only factor that's causing a 40% jump in July new listings truly isn't rooted in reality and in the data. Condos, you guys, it's a lifestyle. It's not just a property type, and the many benefits of that downtown condo living lifestyle are on pause, right? I suppose you can, but people are a little bit less inclined to walk to get a beer, get a glass of wine. A little bit less inclined, well, pretty much impossible to go to a theater, Guthrie or Pantages or Orpheum, right? Pretty hard to see a play these days, or a film. Restrictions on the number of people at restaurants and bars and stuff like that. It's just a different dynamic. So as some of those amenities are no longer, are temporarily not available, not accessible, that can change the dynamic a little bit. What I will say is, I think there's a lot of, well, not a lot. I know that a lot of the people who are making decisions based on 3, 4, 6, even 12 months, who are making a decision that could be a 10-year decision, it may seem short-sighted. So just something to think about there. And with that, shall we open it up?
Yeah.
What are we on time? 3-5 minutes?
Looks like we could have one question that came through. Maybe people aren't selling because they can't buy another one because of the job loss due to COVID.
Yes, 100% right. I think Janie nailed it. I should have mentioned that. I know I usually do mention that, but I guess I'm trying to get a lot of other insights and a lot of other data and charts woven in as well. But yes, especially folks who own anything under 200,000 or 300,000, they're either hanging on to it, because it's affordable, and if maybe if a spouse or someone in the household lost job, lost income, you're right. It's hard to get something at that price point in that location where they want to be. There's also some folks who will choose to list because of that financial hardship. So, there's kind of both sides of that. Some people hunker down and say, I like my payments on this home. I like my location. I'm close to family, friends, amenities when they open back up in large enough numbers. So I think there's dynamics sort of on both sides of that coin, if you will. Other thoughts, insights?
Yeah, we have a couple minutes here, so I can wait and see if anything else comes through, but not seeing anything at the moment.
Okay. I suppose I'll just do a really quick reminder for those who are sticking around.
Here is one more, David. Sorry.
One more. Okay, Jeff. So due to the quick rebound in listings or pendings as of late, when schools start with its uniqueness, are you willing to forecast third quarter? Oh boy, Jeff. It's hard. It's really hard to forecast in this environment. I think so much of it does depend on the course of the pandemic. I'm not extremely confident that we'll see, a vaccine third quarter, maybe even fourth quarter. It's possible, and I don't think I'll sign up to take that Russian vaccine that they claim works. So, I think it depends on the pandemic. I think it depends on sellers, whether we are able to fuel this demand. That hinges so much on sellers. I think part of it is builders. Can builders continue to supply, new homes, newer subdivisions, larger homes? Not everyone, although a chunk of the buyer pool is interested in more space, home office, telework, maybe a yard for kids if millennials are finally starting to have families. So it's so dependent, based on what we're seeing lately. And since technically, right, April, May, June. Yeah, July is technically the first month of third quarter. So we're basically halfway through the third quarter. And so far, it's looking relatively strong. So I guess I'd be inclined to say, I would expect gains, ongoing gains in pricing, probably in sales as well, assuming, inventory cooperates. But when I say cooperates, it'll only do double-digit decline, maybe 10 or 15% declines and not 20 to 30. So yeah, I think that's all possible. It hinges on so many things. In a couple words, I'd have to say I would expect ongoing strength, perhaps not strengthening, but ongoing strength, compared to earlier this year and last year. But it's just going to be so hard. It's just so hard to predict any of that. Looks like one more from Janie. So many small businesses are still struggling or out of business. That has got to affect the market eventually. Yes, I think it will, particularly with those amenities and the shopping and the nightlife and dining downtown. I think that has impacted the condo market, in part to an extent. I don't think it's the only factor. And I also think people realize that it's going to open up eventually. It'll be different. There's going to be more hand sanitizer. There's going to be people wearing masks. There's going to be a little more distance. But, I don't know. I don't want to say things will get back to normal, but things will get back to the new abnormal. How's that? I like that. Things will get back to the new abnormal. And, it really does feel like a big disruption now. And I think it will change, it will change things for decades. But to say that we're never going to have nightlife downtown, to say we're never going to have dining at restaurants, to say we're never going to be able to see a play or a movie again, or fly on a plane again, or go on a cruise. Well, the cruise thing still scares me a little bit. But again, some of that seems to be a little bit overblown. But yes, in some of those small businesses, those are homeowners as well. And so, some of those could hit the market. Remember, we're still so undersupplied that even if we did see, a heightened level of listing activity, we're still going to be in a seller's market. It would take a lot of new listings to push us into even a balanced market, much less a buyer's market where buyers have control, and where they're making lowball offers less than list price or asking price. So, one thing we're watching, changes in any foreclosure and short sale activity. We're really not seeing anything yet. I think we saw a tiny bump in short sales, but it was like from 6 to 12 or something like that. So, again, and I should also say this applies to Jeff's question and Janie's thought. A lot of this depends on Congress, you guys. I know we're in a hyper partisan time. We're gridlocked in so many ways. The congressional approval rating is about as low as it's ever been. But, can our national leaders get their act together enough to rescue the American economy, the American middle class, the American worker? And I'm not necessarily talking about handouts, but with investments. Do we have to let people go into, through no fault of their own, if they lost their job and their income through no fault of their own, in the richest, wealthiest, most powerful country on earth, should these people fall into despair? I think that's a reasonable question. I'm getting a little bit into Eric territory with government affairs and politics, but, so much of this depends on the forbearance period. Whether we can do more of those investments, $600, $200, $300, $400, I know there's a lot of back and forth on that. Nobody wants to incentivize people not to work. However, it doesn't feel like this is a time for ideology. This is a time to prevent our economy from going into a depression. This is a time to prevent families and people, from falling into even harder times than they find themselves in. So, yeah, there's a lot going on there. Janie has one last thought. Healthcare is bankrupting some people too, especially with COVID. That is an absolutely true statement. And while healthcare is outside of our purview, I think that is a fair point. And no matter your thoughts, no matter your preferences, no matter your partisanship or who you intend to vote for, please, please, please go out and vote this year. Do not care who you vote for. Up ballot, down ballot, federal, state, local, does not matter. Please go out and vote. Make your voices heard, and participate in our democracy. And with that, I know we're a couple minutes over, but I want to say thank you guys so much for joining us. I also want to say thank you to our sponsors again, Bell Bank, North Star, Royal Credit Union, and Supra. I also want to mention, as always, a recording of the webinar will be available on our COVID page. And I encourage you to join us next month as well. Have a wonderful, wonderful day. And I hope to see you guys next time.
Awesome. Thank you, David.
You betcha.